My father last week when it was my worst day from the COVIDness. Horrible, horrible sinus headache. It's terrible. He calls me, and since it's him, I pick it up just to make sure everything is fine. He goes, Marcos, I have a question for you. I need your help. All of my golf buddies have been trading Robinhood. I just opened an account. What do I buy?
You're trading in Robinhood. Oh,
Yeah, but he's like on the line, in the line, right? He doesn't know what he's talking about. And I've never felt more like I was in a movie than my father calling me and saying, I just opened up a Robinhood account. What do I buy? Which he's never heard of. And he doesn't even know what he's doing. He didn't know what Robinhood was. He wanted to buy it. And I said, no, that's not. And I said, okay, this is great. This is a funny story. So we'll see how it goes. I don't know if he's bought anything yet.
well, how many clients have we heard from over the last few weeks where they're just like, well, the market's done well, the portfolio's done well, but it's not like Tesla well, not well like cryptocurrency well. It's like, since when is
Crypto, man.
27% on the S&P not well?
I don't know, dude. I'm just waiting for that metaverse ETF to drop. Just kidding. It already exists and put all my money in it. No, I didn't do that. What's my favorite movie, Brett? What's my favorite movie all time?
Mission Impossible.
No, I love that franchise, though. I'm a Tom Cruise fan. Never Meet Your Heroes, though. My favorite film all time. Jaws, 1975, Spielberg, age 27. Named the shark Bruce after his attorney. Jaws is the best, man. Robert Quinn, Richard Dreyfuss. I'm all in.
Make you scared of going in the water?
I couldn't take a bath, Brett. I couldn't take a bath. I was way too young. I was like 12 or 11. I'll never forget the living room. First house I ever lived in. I was sitting on my dad's lap and I was reluctantly watching, knowing that it was just penetrating my psyche and ruining a lot of things. And I watched it anyway. I loved it. I respect sharks a lot because of that film.
I would avoid Australia because you got a lot of sharks there.
I'm gonna go diving with the whiteys, dude. Whiteys meaning great white sharks.
Yeah, got it.
Yeah, but
As
that
a
movie
kid.
is the best. It launched summer blockbusters, man. That was it. You can talk to anyone that's in their like 60s, early 70s, and they remember that movie dropping and just changing everything. Like going to the beach changed. Yeah, dude, I couldn't take a bath forever and ever. The deep side of the pool was just like magical trap door on the side of the pool where a giant shark would come out and then eat you. That was my irrational childhood fear.
So welcome to Talk Your Chart. Brett Horowitz here along with Marco Segrera. And today we are going to try to not argue like an old married couple. So let's start with something that's in the news and I think a lot of people are talking about. And it reminds me, or I think about first, the fact that the Olympics are coming up, Winter Olympics. You a big fan?
I forgot that the Winter Olympics were happening. Is that China? No.
Yeah,
Right.
bobsledding, no, curling.
Oh, curling. I love curling.
Usually the U.S. does quite well when it comes to Olympic sports, maybe better in the summer than the winter. In any event, what I want to talk about is U.S. domination, which is happening hopefully in the Olympics, but is also happening in the stock market over the last 15 years.
Absolutely.
So the chart that I've got pulled up is a chart going back for the last 15 years showing how dramatic the Vanguard Total Stock Market Index and the S&P has done versus the EFI, which is Europe, Asia, and the Far East, and emerging markets. So you're seeing here that they're more than double, in some cases almost triple, what the other indices have done over the last 15 years. And I think what we've read with a lot of commentators recently, and I want to know your reaction on this, is everybody is in the camp that going forward, it's going to flip. Vanguard has about a 2% premium on what they think foreign will do versus US. I know you guys looked at a big study last year of 39 firms. They all had foreign beating US. How can this not possibly happen?
Yeah, I think that's a good point. And it makes me nervous always that everyone's always calling it, which is kind of like it seems too obvious. So you got to take the other side of the coin, be a contrarian maybe. But the issue is people have been calling for a reversion to the mean for several years now. And I feel like I almost remember in 2012, 2013, this is when it started. So eventually everyone's going to be right. You know what I mean? And that's just the issue with trying to make prediction.
Right.
You can just keep doing it, oni. Eventually you're going to be right.
Right.
I think, unfortunately, the dumb answer, boring answer to this is you don't know when. So you got to own it broadly in a portfolio if you're going to be thoughtful about it. The only thing I tell you, and I know you'd agree with me here just because the academia is there, is, okay, why do we think international is going to outperform US? Valuations. Look at past performance. Okay, that's fine. But international markets have a natural lower price than US markets because there's a quality factor that comes in, right? So are they cheaper for a reason? Probably. Do they stay this cheap for the next 10 years? Probably not. When is the outperformance going to come? I have no idea whatsoever.
Well, isn't it like interest rates, right? We all said that for years, interest rate would rise. And for years, we've all been wrong. But you got to think at some point it's going to happen. And if you look at the charts, going back to all the cycles, going back to the 1960s, and I've got another chart pulled up here showing US versus foreign performance. And there's wide and long periods of time where foreign beats US for 5-10 years, then it flips for 5 or 10 years, and it's reversed. And so I think valuations are a big part of it. But what I also know is that the US is more heavily tech oriented, which will do worse when interest rates rise because most of those earnings are in the future. And so there's a little bit of discount there. We know that some of this stemmed from back in 2009, 2010, 2011, when the US gave out a lot of money, put a lot of stimulus out there, while Europe went with their austerity route. So they've given up on that because that did not work. And then something you mentioned last few episodes is that with all this regulation coming out, with all this talk about fines, with all this animosity against these big tech companies, I think that it's foolish to say, just get rid of US, get rid of foreign and only own US because it's never going to change.
That'd be foolish because that would be operating in an extreme. And I think we both agree the best, most thoughtfully built portfolio is not going to operate at an extreme. So that automatically kind of throws that away to try to pick the winner. I don't know what's going to cause it to turn, but you could see next year, if rates actually increase, that could be the start of it. My only concern is I'm in a camp where, sure, rates might increase. I don't think the magnitude of the increase is going to be as large or as impactful as some people are perhaps framing it to be.
Yeah, perhaps not. But I think that if you look at the statistics, to just say and to just think the US is going to beat foreign forever going forward, just because our economies are doing so well, just because we've got a younger population, just because of lots of factors, I think that's misguided. And the Wall Street Journal had a very interesting article a few years ago, and I'm going to quote this article in this one sentence. It said between 1993 and 2010, China's GDP expanded by an inflation-adjusted compounded annualized rate of 9.5%, while the real return on its domestic stocks clocked in at a far more modest 2.2%. So I know people like to think, go where the growth is, go where money's being made, but prices come into that equation. For currency exchange comes in that equation. Government comes in that equation, right? It's not just about where the growth is and about one little factor here or there.
Yeah, I'd agree.
So I think without a doubt, foreign will beat US over the next 10 years. Put my money on it. And I hope that clients remain diversified and not just every year want to throw out the worst performing part of their portfolio.
Okay, good. I'm just writing this down. BH foreign markets will outperform US over the next 10 years.
2031, lock it in.
Signed and dated. That's it. Hopefully for the 100th episode of Talk Your Chart, that's probably not the right number, but you understand what I mean. We can check that prediction.
And if my prediction's wrong, we just won't ever air this episode again.
Okay. That sounds perfect. Oh, like weathermen, financial weathermen.
There you go.
Predictings for the weather or something like that. Okay. So,
So you're going to predict something now.
oh, maybe, but let's go through the whole thought process of how I got to this. There's a ton that's happened over the last 2 years, right? 2020 and 21. So coming into the end of a year, what do a lot of people do? You want to be reflective. You want to think about what's come before you. You want to try to use what's come before you to thoughtfully present a case for what might come next. And where it basically put me is this idea of, all right, what are some probably unanswerable questions, but important ones that we ask ourselves as advisors on our investment committee and probably just across the company? So these are kind of 8 questions I had in my mind, thinking one of them could be a good topic for us to discuss. When will the pandemic subside significantly? How much will the economy grow in 2022? FOMC, for example, expects about 4 to 5% year-over-year growth. Will the remaining 4 million jobs that were lost in 2020 return in 22? Will the labor participation rate get back to the February 2020 levels, right? So pre-pandemic levels. To give you an idea, that labor participation rate was 63.4% February 2020. Right now it's 61.8. Will the rate of change of inflation decrease by the time we get to December 22? Will the Fed raise rates in 22? And if they do, by how much? What will happen to housing prices in 2022? And will home inventory continue to decrease or increase as the pandemic subsides? So I thought all of those were incredibly important questions that we could talk about. But I got something in my inbox that talked about the dogs of the Dow. And I said, forget all the important, thoughtful stuff. Why don't Brett and Marcos make some predictions for 2020 instead and not talk about anything that's all that important?
Well, predictions, Marcos. Speaking of that, we just got an article of the day. 85% of active mutual funds underperformed the S&P 500 over this year, right? So if you want to beat the S&P 500, you probably got to get most of those questions that you just asked right? You can't go 4 out of 8. You might even not be able to go 3 out of 8. 5 out of 8. You probably got to get almost all of them right in order to outperform what the market's going to do.
You absolutely have to get a reasonable amount of those correct if you're going to invest in public markets like that, because it's not enough of an asymmetric relationship. But anyways, forget all the thoughtful stuff.
Do it every year after that as well. Right?
Yeah. I get it, man. It's not going to work. One of us is going to be wrong, though, a year from now. And that's all I care about. So here we go. What chart did I bring us? I brought us a chart of the dogs of the Dow going into 2022. Brett, the Dow, your favorite index of all time, your favorite thing since the often quoted sliced bread. You know what the dogs of the Dow are, correct?
Yep, but go ahead.
Okay, let's a quick primer, right? So the dogs of the Dow theory. The theory holds that the 10 stocks in the Dow Jones Industrial Average that end any given year with the highest yields end up outperforming the index the following year. Underlying this theory is a reasoning that components of the Dow are well-established companies that tend to raise their dividends in an orderly, methodical fashion. This theory of the so-called dogs started in around 91. A gentleman by the name of Michael O'Higgins is the one who came up with it. He and others postulated that companies exhibiting high dividends also had stock prices that suffered partly because their operations had encountered temporary setbacks and were likely to recover the next year. So it's a fancy reversion of the mean play, right?
But let's be clear. When we talk about dogs, we're not talking about cute, lovable, like these are our favorite friends. Dogs meaning ugly companies.
We're talking about ugly, publicly traded companies, but specifically that are composed in the Dow, right? So of those 30 companies, take the ones that have performed relatively crappy, and over the next 12 months, they should outperform the other ones that have done well. That's basically what this thing is saying. So let's frame this a little bit. There's, of course, a website called Dogs of the Dow that you can go on and probably pay them money to give you information to do whatever they're going to suggest. They do quote some performance here, which is, and there's also the dogs of the Dow. They're the small dogs of the Dow. There's dogs of the Dow X. So obviously there's a bunch of crazy iterations that I'm sure you have to pay more to get. What we're using, just so everyone knows, is it's at the dogs of the Dow generated list where they think this is what's going to be the resulting 10 names at the end of this year. It could change. But if you look at the chart that we put together, we're looking at JP Morgan, Intel, Coca-Cola, Amgen, Merck, Walgreens, Chevron, Verizon, IBM, the Dow, right? So Dow Industrials, Dow Incorporated. And then I threw on this chart, Brett, the pink line, which is actually the diamonds, right? The DIA ETF, which is just owning all 30 companies. And what I thought was interesting, not that it necessarily matters because obviously these things change over time. When I look at this chart and I include the Dow, right? The Dow company as the one that has the shortest lifespan right now. So it only goes back to March 2019 because of some share spin out stuff that we don't need to get into. But just interestingly, since March 2019 to now, only one company has outperformed the actual index since then, and that's JP Morgan, right? And if we remove the Dow so we can look back even further, right? Again, just taking these 10 companies, if we go all the way back to, I think late 90s is where I can get to. Yeah, so basically February 98, only 3 of the 10 companies outperformed the benchmark, right? One of them being the only meaningful outperformer was Amgen that did over 2,000%, while the index did 680%. So all that shows me is it's tough to pick winners. And usually you're best served by choosing a basket of companies to make sure you don't underperform. Because if you were like a lot of people thinking, you know what, I'm going to buy Coca-Cola because it's a strong company, it's always been consistent. Well, for the past 20 years, you own Coca-Cola, you did 240%, while the index did almost 700%. So yeah, Coke's still around, but you meaningfully underperformed an index. So that's kind of the one signal that I'd garner from this whole individual stock picking stuff.
I think Warren Buffett said it best. He said, instead of looking for a needle in the haystack, just own the whole haystack.
Buy that haystack. I get it. I've heard of Warren Buffett. I'd take his sage advice. So here's what we're going to do, Brett. Here's what I want us to do. We're looking at the 10 companies here. A year from now, I want to see who wins. And I think you should pick a company and I'll pick a company. And we'll get together a year from now, assuming they're still letting us do these videos, and we'll see who wins.
So I would start off with, I think most clients would look at this, and if this was in their portfolio, they'd look at it and say, well, JP Morgan Chase did the best over the last few years. And so I want to own more of that, and I want less of Verizon. So I'm going to take the exact flip side of that. I'm going to take Verizon, which I think had the worst performance on that chart. And I'm going to
year to date. Hold on. Are you trying to? So do you want me to give you the year to date figures? Would that be helpful?
No, I'll go with this. I'll go with these numbers.
Okay. Do it. All right. So you're talking about, so you're taking Verizon over the next 12 months.
I'm taking Verizon for the simple fact that they have done the worst.
Yep.
I don't know about cheap, but I'm sure they're pretty cheap right now. And just like you got a beautiful, we talked about in the first episode, a beautiful house at some point is going to be too expensive to buy. I want to take the bad house in the bad neighborhood and hope that we'll be able to renovate that and turn it into a nice house when the whole sort of area gets picked up.
Got it. Bad house, bad neighborhood. Brett's taking Verizon. Okay, I like that. Now, let it be known, although I saw this list before, I haven't done any diligence research. Not that that would matter. 85% of active managers underperform. So Brett's taking Verizon. I am, funny enough, going to do the opposite of what you're saying. I'm going to play off the momentum, and I'm going to say, and again, this probably has nothing to do with anything, with rates going up next year, Brett, when interest rates go up, what segment of the economy benefits when rates go up?
Financials.
Financials, baby. Give me JP Morgan, give me Jamie Dimon over the next 12 months against your Verizon.
We shall see.
Wow. This is exciting. Can't wait for a year to pass.
Yeah, I think picking these individual stocks is impossible. I think if someone wants to play on the market, they can do so. Someone wants to invest a few dollars here and there just to try it out, to buy a Robinhood, to buy a meme stock, whatever it may be, fine, go ahead. But as we see here, thank you for bringing this up. It's ridiculously hard to do this over and over and over again to predict who's going to win.
Yeah, it is. Look, you said it. Buy the haystack. Buy the haystack. That works. All right, good. What else you got, BH?
I think that's it.
I think that's all, man. Have a great new year. It's been a pleasure to work together in 21. I look forward to 22.